All right. Hi, everyone. It's Dr. Steph. I'm an assistant professor at the University of Toronto Faculty of Medicine. Today, I'm joined by Dr. Mark Soth from the Looney Doctor blog, and we're back again for a video on income splitting. This will be our last video of the summer before we come together again for a talk about physician pension plans at the Physicians Financial Wellness Conference on November 18th of this year. If you're a program director and would like to invite Mark and I to speak to your residents, feel free to send a message on the About page of this channel. And if you have any questions about this talk, please leave us a comment.
So we're going to try to go through this in a systematic way to talk about how income splitting works. So there are some previous videos that are relevant to this. So there was Stephanie's video on Should I Incorporate, where they talked about some tax basics with corporations, income smoothing, tax deferral, and some of the pros and cons of incorporation. And then we also talked about paying salary and dividends from a corporation in another video. And that has impacts on what are called corporate notional accounts, which are accounts that track some of the tax refunds and savings that you can have based on taxes that your corporation has already paid. So those are all going to be relevant in the background for today's talk, because we are going to be talking about income splitting using salary, dividends, and it all kind of mixes in there.
And I'll link those videos in the top of the screen and in a description below as well.
Great. So just my disclaimer, I am a physician. I'm not some kind of financial professional, so I don't advise about or sell specific financial products. My main goal is to educate health professionals to take control of their financial health. So none of what I say is specific financial advice or recommendations. It's information for you to know about so that you can talk to your accountant or whoever's doing your taxes, and also plan with them how you're going to pay yourself and possibly your spouse from your income. So what we're going to cover a bit about the what and why of income splitting, hiring a spouse, dividend splitting, TFSAs and spousal RRSPs, low-income spouse investing, and spousal loans. So there's lots of options that are out there. So the first question is, what is income splitting and why would you bother with it? So the idea of income splitting is to try to equalize the income between both partners in a household, so the taxable income. And the reason why that could be important is because Canada has a progressive taxation system. And so that means that as you earn higher amounts of income, you pay proportionally a much higher percentage of tax as your income rises. And the other part of that system is that income is attached to an individual, not a household. So the result of that is that you can have two different households that have the same income coming in, but they pay drastically different amounts of tax. So this is just an example here where we've got a household that makes $300,000 in income. One partner is the partner that earns all of that income outside of the home, making $300,000 a year. The other partner's supporting that, but doesn't make any income outside of the home. So all of the income is going to be taxed at that higher income earning rate. So $119,000 in tax, that's going to leave $181,000 left over. Now, if you took the exact same household income, $300,000, but it was evenly split between the partners, so both of them were earning the exact same amount of income, they'd pay $45,000 in tax each because they're staying in much lower tax brackets, and the net household income would be $210,000. So depending on how you organize the finances with your family, it can make a very big difference. So we have two households making $300,000, but one has $30,000 a year of more buying power than the other one does, just based on how the income's distributed between the two partners. So the idea of income splitting is trying to even this out so that we're not losing excess tax within our household. So there's different ways to do that, and it may not matter for everyone. So if both spouses are in the highest tax bracket, it's not going to matter. If both spouses are in relatively low tax brackets, it's not going to matter that much just because the tax rates are lower. But a lot of us could fall into this category where, one spouse earns quite a high income and the other spouse earns a drastically lower income. And that's where income splitting is going to come in handy. So there's lots of ways that you can do that, whether you're incorporated or not. It doesn't have to be incorporated to income split. That's one of the myths that's out there. Anybody who runs a business can hire a spouse to work within that business or another family member and split income with them by paying them a market rate salary. So that's the key with salaries. It has to be market rate. You can't pay someone $100,000 a year for a job that you would otherwise be paying someone $20,000 a year. It has to be the same type of rate that you'd pay an arm's length employee for the job. So that's the main limiter of it. Some people try to make their spouse like a contractor where they just pay them money here and there for jobs done without having to make a payroll and remit taxes to Revenue Canada. That's usually a no-go. You have to treat them as an employee. If over 90% of their business income from whatever service it is they're providing, it comes from you, then that's really more of an employee relationship, not a contractor relationship. A contractor would be providing service to a variety of different companies. So you have to set up a payroll. And the reason why Revenue Canada gets upset about that, because if you don't set up a payroll, you don't have to make monthly remittance of taxes. So you have to set up a payroll, and whatever you pay your spouse and their salary, you'd have to make monthly remittance of CPP and the taxes that are normally deducted at source, so that the government gets their money in a timely fashion. It's also a good idea for them to keep a work log and a timesheet. So you want to document the work that they're doing so that it's clear that it's a legitimate employee relationship. The other reason why that can become important is it can have some of the criteria met potentially to dividend split, which is a much more powerful way of income splitting. So I just want to highlight the benefit of this within a corporation. So let's say we have a corporation and it doesn't matter what the income of the corporation is, but let's just say there's $200,000 of corporate income and you're not income splitting. Well, if you were to pay $200,000 from that corporate income out as salary to the owner, that'd be about $66,000 in tax, and that would leave you about $134,000 after tax cash in hand. Now, by income splitting, let's say you had a spouse that you could pay $25,000 a year salary to for providing bookkeeping and maybe some basic billing and other things for the corporation. Well, that $200,000 of corporate income can be dispensed out as $175,000 to the owner, $25,000 to the spouse. And because you've essentially shifted over some of that income from a very high tax bracket down to a low tax bracket, we're assuming here that the spouse has no other income. If they had no other income and all they were getting is $25,000 a year with the basic personal allowance that people have, that would be basically no income tax due on that. And then the $175,000 paid to the owner would be $54,000 in tax. So you can see they'd have $146,000 cash in hand afterwards. So they've saved, $12,000 worth of tax by using that salary. Now, that's the real benefits probably even more, because if you weren't paying your spouse to do that work and you were paying someone else to do it, well, that's $25,000 that you'd be paying to some other external service to provide that service to you. So really, if you took that $200,000, pay $25,000 to some billing agency or bookkeeping or whatever that's doing that work for you, and then you'd have $121,000 tax in hand afterwards. So much less. Yeah.
Oh, and I just wanted to make sure. So this is not just for spouse, right? You can also income split with kids once they reach the right age. And then what about for like family members as well? Do we have any information on that?
Yeah, you can pay a spouse to anyone. You can pay a salary to anyone, right? It just has to, the key with salary, it has to be market rate. So you can hire a parent, you can hire a brother or sister, whoever that you want to split the income with. Just realize that when you're giving them that income as paying them as for the work done, it's their money. So, unless your parents are paying your bills or your brother or sister or whoever you're hiring is going to help pay the bills for your household, then that is moving money out of your household to somewhere else. So yes, you can hire other people. And if you're looking to help other people with some employment and income, then sure, it works for that. But that is money that's going to be going outside of your household itself. Okay, so that's splitting with salary. So the other kind of way you can split with a corporation split your income is with dividend splitting. And the big advantage of dividends is that they don't need to be market rates. So all you have to be getting a dividend really is be a shareholder in a company. And being a shareholder in a company, the company decides what dividends to pay out. It's not really tied to any market rate. So you could give $100,000 dividend, you could give a $50,000 dividend. You could give whatever. It doesn't matter about any work being done. So the main limiter of using a salary, of course, is that market rate. So you can't pay someone massive amounts of money for small amounts of work. Now, this was a way of income splitting that was much easier to do before what came out was as called the tax on split income rules, or TOSI rules. They came out around 2018. And those rules were meant to try to prevent income splitting with inactive shareholders. So if you have a professional corporation and you're the physician working in it, you would be the active shareholder because you're working in the business and earning an active business income. But if you had a shareholder that did no work for the business whatsoever, they just had a share on paper, well, that's an inactive shareholder. So you could technically have kids, parents, or a spouse as an inactive shareholder. So these rules were meant to prevent us from giving those dividends to those people. What happens if you do that is it's basically taxed at the highest marginal tax rate. So there's no advantage to doing it. So those rules were meant to prevent that from happening. Now, there's a whole bunch of rules and exemptions that go with it, but there's a couple that are relevant to doctors. One is that if the owner or the spouse is over the age of 65, then you can dividend split again. So it is still useful to have a corporation as a retirement planning vehicle. And that's the same age where other people with pensions can pension split too. So it's meant to kind of keep that a little bit more fair. The other way that you could potentially give dividends to a spouse is if they are not an inactive shareholder, but if they actually are providing enough active participation in the business. And they've made a bright line test for that, which is more than 20 hours per week worked for the corporation during the times that it's open. And that's important to know, because let's say you had a practice that closed down for 2 months every summer completely, like no business was conducted whatsoever, then those 2 months during the summer wouldn't count for terms of the average hours. It's the average hours during the time when the business is open. So the other couple of wrinkles in there are that if you do want to give a dividend, it would have to be from the year where they currently did work more than 20 hours a week for that year. Or if over the course of time, they've accumulated more than 5 years of having done more than 20 hours per week of work, then you can dividend split with them forever moving forward. So those 5 years don't have to be consecutive. They could be on and off, but it has to accumulate to 5 years. And it's really, really important if you were considering to do this to make sure you kept the right paper trail to document all of that. That's why having timesheet records, payroll records, and work logs all support that this work was being done. Because if it's ever asked for, you'd really have to be able to provide that. Okay, so how do we decide? We talked about income splitting with salary, income splitting with dividends, but this kind of income splitting is only part of the equation. When we're thinking about how to pay ourselves in our corporation, we want to have a mix of salary and dividends that keeps the corporation efficient. And I'm just going to go through this very briefly, but there was that previous video that we did on salary versus dividends that goes into it in much more detail. But the basic idea is, I'm going to start with a small business has access to the small business deduction. So that's many professional corporations. There are what are called notional accounts in your corporation, where the corporation's paid some tax and you have some ways of moving money out that either is low tax to you or a refund of the corporation. And you want to make sure that you're taking advantage of those, whether you're income splitting or not, when you're deciding how to pay yourself salary and dividends. So if you had capital gains in the corporation that you realized and you have a balance in your capital dividend account, you want to pay a capital dividend out, which is tax-free. When you earn investment income, the dividends get taxed in the corporation and goes into this refundable dividend tax on hand account. So if there's eligible dividends, then you pay out eligible dividends and your corporation gets a tax refund. So if you need the money and you have those balances, you want to be paying some dividends. And the same thing with ineligible dividends. If you get interest or foreign dividends or rent income to your corporation, that's passive income, then it gets taxed at a high rate up front at the corporation, and the corporation gets a refund when you pay out ineligible dividends. So you want to make sure that you're paying out enough dividends that you're able to release those taxes back to your corporation. Now, below those accounts, which are less important, there's something called GRIP, which is if your corporation pays some taxes at a higher tax rate, and then you can pay yourself eligible dividends. But after that, really, it's salary. And the salary, again, you'd want to try to split that up as much as you can, but your spousal salary is going to be limited to the market rate. So you'd want to look at how much, let's say you couldn't dividend split, but you had to pay some dividends to release all of those refundable taxes. You'd pay, the owner would collect a bunch of dividends, and then afterwards you'd pay spousal salary and an owner salary, trying to equalize those as much as you possibly can. So as you can imagine, the math gets kind of complicated to do that, which is why I've got that income dispenser calculator, corporate income dispenser calculator that Stephanie and I did a video on previously, which goes through all of this in the background. Now, if you have a corporation that doesn't have access to the small business deduction, so for example, if you have a practice with that you share with a bunch of other physicians and you all share the small business deduction, essentially you don't have much access to it. And Quebec has some times where you're not able to access a small business deduction, or if you have income that's at a high rate. The process is basically the same, except that you'd want to pay salary a little bit earlier in the process. So you pay dividends to get all those refundable taxes out, and then pay salary to try to equalize it as much as you can. Now, if you are able to dividend split, then it makes all of this very easy, because you just try to split the dividends between the two of you, pay out some salary to kind of equalize it as much as you can. So mixing your income splitting with salary and dividends within a corporation can get kind of complicated. But this algorithm is the algorithm that runs in the background of that corporate income dispenser calculator that I'd made.
So essentially what you're saying is that it's great to not only just income split with your spouse using salary, but you should also take advantage of all of those dividend notional accounts that
right.
You can pay your spouse through dividends as well. So it's good to pay yourself a combination of dividends and salary, but also your spouse in the same manner.
Well, yeah, but if you're not allowed to just pay your spouse dividends, then you would pay yourself the dividends first.
Gotcha.
So you'd pay yourself dividends and then pay salary after that to make up whatever the difference is.
Makes sense. Great.
Yeah, if you can dividend split, it's easy, but most people can't. So paying, and the amount of dividends you'd have to pay when you're starting out, it's usually quite low, because you're not going to have a lot of investment income in your corporation. That's what makes you have to pay dividends.
And just to clarify something, so if you are a sole proprietor, not incorporated, would this algorithm still apply?
Well, you're not a business, incorporated business then. So you'd just be collecting your T4 income for yourself. You could pay a spouse's salary, which would become a business expense. So you would be able to income split with salary, but all of the dividend stuff only applies to corporations.
Right. Okay, great.
Now with that algorithm, there are times where, let's say you did have to pay yourself a bunch of dividends, and you pay to make, to release all of those taxes, and you don't have a very high cost of living. There are times where you'd still want to pay a spouse a salary anyways. So let's say you have to pay enough dividends to cover your cost of living that also releases all of your refundable taxes in your corporation, and you don't need to pay your spouse a salary to income split. You still could pay them a salary if their salary is quite low, because there are times where the average tax rate for the person is less than the tax rate of a corporation. So a corporation is going to have a small business tax rate somewhere around 11 to 12, 13%, somewhere in that ballpark. And depending on your province, you can pay $30,000 to $40,000 and have your average tax rate be below that 11%, or whatever the small business tax rate is for your province. And the same thing could apply if let's say your corporation had to pay taxes at the higher tax rate. Let's say it makes over $500,000 a year, just doesn't have access to the small business deduction. If you didn't need the money, you still may want to pay out income enough to at least, make your average tax rate closer to the corporate tax rate. So depending on the province that you're in, and I'm just going to use Ontario as an example. So let's say I paid out enough dividends to release my refundable taxes and some basic salary to myself, and I didn't really need any more money. But I have a spouse who works the corporation. Well, I could pay her a salary limit, as long as it's below the market rate. If it's under $45,000 and they have no other income, then they're still going to pay less taxes on that than if I'd left that money in the corporation. So you actually get more tax deferral by paying out some salary than you would have by leaving the money in the corporation. So that can happen to people that have low costs of living. So I've got this little chart here that goes through it by the province, comparing the average tax rate of the person and what level it's below the either small business rate or general corporate tax rate. So that's sort of income splitting in the short term. So short term paying on a 1-year basis, trying to even out those taxable incomes. But the other way that you can try to income split is a longer term strategy where, let's say I'm earning a bunch of income with my corporation and my business, and I have a low income spouse. Well, if my low income, if we have extra money to invest, then it makes it more sense generally for my spouse to have it invested and taxed in my spouse's name if they have a much lower income than me. Now, if your incomes are very close to each other, that you wouldn't bother with that. It's better to have joint investments because then it's very seamless. But if you have a big difference in your tax rates, then it can be worthwhile. But this is a long-term strategy that takes years to build up. But we're going to talk a little bit about how that works. There are rules, of course, to try to prevent us from doing that. So there's something called the attribution rules, which we're going to talk about. You can use tax-free savings account, spousal RRSPs. A lower income spouse can have their own taxable account. Even though there's tax on it, if they're in a very low tax bracket, the tax is almost nothing. Or could you actually be effectively a negative tax rate? And there are ways a higher income spouse can loan money to a lower income spouse to invest. And there's some rules around that as well. So I'm going to cover off each of these ways of income splitting. And these are ways of income splitting that are available to everybody. You don't have to be incorporated for this. Any Canadian can do this. So what are the attribution rules? The attribution rules are basic rules to try to prevent us from giving money to a spouse or one of our kids to have them invested and be taxed at a very low rate in their hands. So what it does is that if you try to gift money to a spouse or a minor and they invest it, any income they earn from that will actually be attributed back to the higher income person that gave them the money. So that's why it's called attribution. And then it gets taxed in their hands. So if I gave my daughter $20,000 to invest, any income she made on that $20,000 would actually be taxed in my hands. And when I say income, I mean interest and dividends. So the other thing you can't do, you can't just loan money to a spouse at 0% interest and have them in investment. There's rules against that too. So if you do loan money to invest, it has to be at a prescribed interest rate, which is a rate that Revenue Canada sets. I think it's around 5% now. And the lower income spouse has to actually pay that interest to you. They can't not pay it. It has to be paid. And when it's paid to the higher income spouse, it's taxed as income from the higher income spouse too, because it's basically interest income. You also can't have a spouse use your credit basically to invest either. So if you have a line of credit because you're a professional that's based on your credit rating, your spouse just can't take that money and invest it and have it be attributed to them. It would actually be attributed back to you. So it can't be based on your credit score or your future income in the case of residents and physicians. So this applies to investment income, and it gets taxed in the high spouse's hand. That's interest, dividends, rent, any of those kind of investment incomes that you might earn. Most capital gains would also be caught up in that too. There are ways that you can dispose of the asset at a fair market value. Then you pay tax on it at that time, and then it starts over at a fresh rate. But that can only apply under special circumstances. So if I was considering anything like that, I definitely want to talk to my accountant about it. But basically, most investment income gets caught up in this. The one area that doesn't is second generation income. And what that means, if let's say I invest in a stock and I get paid dividends from that stock, and then I take those dividends and I reinvest them, well, the dividends that are earned on those reinvested dividends are not taxed. So you can imagine that just, that's mind bending. One, it's going to be a very small amount of money. Because it's only the dividends on the reinvested dividends, which is going to be minuscule until a lot of time goes by and it grows. So yeah, it's it's not a subject to the attribution rules, but it sounds like a real accounting headache to me, and it's probably not a lot of money. That said, there are some relatively simple ways around the attribution rules that you can help a lower income spouse to invest and not get caught up with this. So one is to use a spousal RRSP, which we'll talk about. The other is if you have more personal income than you need to live on, so your household has some extra money left over, what you can try to do is to try to have the higher income spouse pay for the cost of living, preserving the lower income spouse's money so that they can invest that. You can use spousal loans, and you can also use an investment loan secured against a joint asset. So this is not the same as a loan secured against your personal credit, like a professional line of credit. This is something like a home equity line of credit or a mortgage against the matrimonial home. So it's not against your credit per se. It's against an asset. So one of the easiest ways we can income split is to make sure that we use our tax-free savings account. So a tax-free savings account is a great investment account, and the beauty of a tax-free savings account is they're non-taxable, which means the attribution rules don't apply. So if I'm the higher income spouse, I can make sure that I contribute to both my tax-free savings account and make sure that my spouse's tax-free savings account gets topped up as well. And that can be done with my money because it's non-taxable. And by doing it with my money as the higher income spouse, that would preserve the lower income spouse's income to invest. So instead of taking some of their money and putting in their tax-free savings account, if we don't need that money, they can actually just invest it in their name on top of that. So they get both the tax-free savings account plus extra investments on top of that.
Is there any way for the higher income spouse to show this as a paper trail that they've given the money to their spouse for the purpose of the TFSA?
Yeah, it doesn't matter. You don't need to. It's non-reportable, non-taxable contributions. So
Got it. So they could just transfer the money to their spouse, and then their spouse will just put it in their TFSA.
Yep.
Oh.
Yep. It's one of the few things you can just do without a paper trail.
Nice.
Now, a spousal RRSP is a little bit different. So what a spousal RRSP is a special kind of RRSP that's opened up. It's owned by the spouse, but it's contributed to by the higher income earner. So for example, my wife has a spousal RRSP. It's owned by her, but I make contributions to it. And the way that this can be used for income splitting is because of the tax deductions and refunds. So for the example, let's say I'm the high income spouse, I could put $10,000 into a spousal RRSP. That contribution room is based off of my income. So it's off the higher income spouse's income. So instead of contributing to my RRSP, I contribute to my spouse's spousal RRSP instead, but I still get the tax refund. So if I'm in the 54% tax bracket and I put in $10,000, I'd get a $5,400 tax refund, which is obviously a lot of money. Then after 2 full calendar years of not making more contributions to the spousal RRSP, that money, when it does come out, would be attributed to the lower income spouse instead. So let's say, 3 or 4 years or many years down the road, my spouse takes that money out, that $10,000 would be taxed in their hands. And if they had no other taxable income, it would be basically very little tax owing. So I got this $5,400 tax refund up front, then tax-free growth over time. And then when it comes out in my lower income spouse's hands, then it gets taxed at a lower rate than the refund that I got. So it's a way of shifting income over. So there's times where this could be useful. I mean, after the age of 65, it doesn't really matter so much because after the age of 65, you can pension split an RRSP anyways. So RRSPs could be income split at that point. But let's say I was going to retire before the age of 65. My spouse having a spousal RRSP might be money that they could draw from at a low tax rate while I'm taking money out of my corporation, for example. So it'd be a way of income splitting before the age of 65. The other time it could be useful, let's say my lower income spouse had some gap years. Maybe there's a parental leave or they take a sabbatical for something, or they're between jobs. If enough time has elapsed since my last contribution, it has to be over 2 full calendar years. But if you plan for it and have some time elapsed, then that money could come out in their hands. But you do have to make sure that you haven't made contributions for more than 2 years. So the other way that you can try to income split with the lower income spouse with their investments is letting them have more money to invest. And it may sound like, well, why would you want them to have money to invest in taxable accounts? But let's say you've maxed out your TFSAs, you've used all your RRSP contribution room, and your household has extra money left over. Well, so the people in the lowest tax brackets actually pay very little tax on investment income. And in some provinces for eligible dividend income, because the credit actually is bigger than the taxes they pay. So they actually have effectively a negative tax rate. So having a lower income spouse build up this investment pot in their name can be very tax efficient. It's actually in the lowest tax brackets, even more tax efficient than a corporation. So it's one of those ways that you can build up money over time. Now, for this to happen, you have to have excess money left over from your household to invest. So if you try to take as little out of your corporation as you can generally, as long as you're able to pay for your costs of living, and you might take a little bit extra if you're at a very low tax rate. But the other ways this could happen is if you have a really low cost of living and you don't need a lot of money from the corporation, but you take a little bit extra out because your average tax rate's so low. You could be paying excess salary to a spouse to income split, like if their personal tax rate's less than the corporate tax rate. There are times where you're going to, when you have a corporation, it's great for tax deferral, but the money's got to come out sometime. And as you get more and more investment income in that corporation, that investment income gets taxed at a high rate up front. So you're going to be essentially forced to either pay that high rate and not get a refund, or take some money out and get some money refunded to the corporation. So there will come a time where you may have to pay dividends out of your corporation to release the refunds that for money that you don't need at the moment. There are other ways that you might get excess money to. Let's say you sold a house and had a bunch of money freed up from that, for example. If you have personal assets that you've sold and made have extra cash in the household from. So you could take that money and invest it. So if you don't have that money, another way of doing it is to use a spousal loan, where the higher income spouse loans money to the lower income spouse. Now, it does require a promissory note, which is an official note. You can get templates off of the internet, but it's an official note documenting the loan. It technically never has to be repaid, but the interest payments have to be paid on a regular basis. And those interest payments have to be at the prescribed rate. It's currently about 5%. And once you put that interest rate, it can be locked in forever. So I probably wouldn't want to lock in the 5% interest rate, but let's say the prescribed rate drops back down to 1%, which it was for a long time. If it was 1 or 2%, you could lock that rate in perpetuity moving forward. So this was an attractive strategy for some people when the prescribed rate was in the 1 to 2% per year range. At 5% a year, it's probably not very attractive as a strategy, but I'm just mentioning here because I know it always comes up. Now, when they do have this spousal loan, it's important that the lower income spouse does pay interest on it, and they have to pay it from their own money. So the interest has to be paid from their income, and it's deductible against their income, but it's also taxed against the higher income spouse's income. So it's generally not worth it for most of us. It's generally not worth it if we're incorporated, because if you had to take out extra money to yourself to then load it to your spouse, well, the amount of tax that you'd pay yourself taking that money out of your corporation is more than you would ever make up loaning it to a lower income spouse. It pretty much never works out. And it's also much more difficult to make this a viable strategy when the prescribed interest rate is high. If it's in the 1 or 2% range, sure, then it might be a strategy for someone who isn't incorporated, has a high income from a salary, and wants to income split. That's the time where I could see it being used. The other thing you could do to try to give your lower income spouse money to invest is they could use a loan that's against your house, for example. So it's a joint asset that you could then take extra money and invest it. So it's essentially a way of using home equity to invest. Now, before ever considering to do that, the first question I'd ask myself is, should I really actually be using a loan to invest at all? Because if you do use a loan, you have to have very high risk tolerance, because using that leverage magnifies your emotions. So when markets drop and you owe a bunch of money on a loan, that feels a lot worse. And when markets go up and you've got a bunch of money that you've borrowed to do it, it goes up. You've made all this money more than what you really would have otherwise, and it magnifies the emotions in both directions. And markets will go up and down. So if you're using to invest, you'd have to be in it for a very long-term time horizon, because there can be market drawbacks or drawdowns, and they can last for many years even. So you have to be prepared to ride out those drawdowns without having to sell those investments and pay back the loan. So I'd also want to make sure that I could pay back that loan without any difficulty, without selling the investments, because the time where you need the money often coincides with the time when the markets are going to be down, because bad stuff tends to happen together. So I wouldn't want to be in that kind of precarious situation. And that's the irony, because most people that are in that type of situation where they could consider into this probably don't need to take the extra risk, because they've got more than enough assets invested. So the other question I'd ask myself is, do I need to take the risk? Do I want to take the risk of using a loan to invest? And those who are in the best position to do that are probably the people who don't really need to do it.
And I guess like right now in 2023, as we're filming this, the interest rates are incredibly high, such that it'll be really hard for you to have any sort of market gains that would top how much you're paying in interest as well.
If you did decide to do it, the way you do it is you could use the home equity line of credit. Just be careful to track what's being invested and not get it all mixed together with personal spending. You have to have a pretty clear paper trail showing this is the money that you took from the line of credit. You used it over to your investment account and you invested it in something that's expected to earn interest or dividends. So you have to have a very clear paper trail. It can also be done with a mortgage as well. So if you're refinancing a mortgage and you refinance it for more than what you had owing on it, then you can get some of that as cash back and invest that. Now, if you do this, then it's very important that the spouse that is using that loan to invest pays the interest on that loan from their own income. So you need a clear paper trail showing that they are paying the interest on the loan, they're using the loan to invest, and they're earning investment income on it. So you have to keep a clear paper trail to document all of that. And that's going to be important if you ever get asked about it. So they have to pay the interest and have to track that they're paying that. It is deductible against their income because they are using that loan to invest and earn income. So it is a way of making that portion of your mortgage or your home equity line of credit as a tax deduction in terms of the interest. So that's a lot of strategies, and it's kind of a big web of different options that you've got. So this is how I would kind of summarize it to put it together in terms of the longer term income splitting. So this would be an example, and you know, my wife and I have used all of these strategies. I have a higher income than she does, but she still earns a pretty substantial income from our corporation. But the way that we work this is that my high income will go into our joint bank account. And then from that joint bank account, we'll fund both the tax-free savings account, pay for all of our living expenses. If my spouse has an extra tax installment that's due, I can actually pay that from the joint account. There is no attribution rules for paying someone else's taxes. So you can pay extra tax bills, and then if I can contribute to a spousal RRSP as well. So this all comes out of the high income spouse's income that goes into a joint bank account. Now, that spousal RRSP, after more than 2 years, that would be able to be attributed to the lower income spouse. Now, the way that we work is, since I'm paying all these living expenses, my wife's income, she's the lower income spouse in our case, her income goes into her own personal bank account. So she has a bank account that's separate from our joint bank account, and it's her bank account alone, not mine. It's not a joint bank account. From that, she contributes to her own RRSP. You have to contribute to your own RRSP from your own income. So she contributes to her own RRSP. She also has her own investment account that she puts money into from her bank account. So it's clear that the investments are coming from her own income. And because of that, any dividends, interest, or capital gains that she earns on those investments are all taxable in her name, not mine, at her lower tax bracket. We haven't used any spousal loans because I'm incorporated. It wouldn't make any sense for me to take that big tax hit to give extra money, but we have used our mortgage for my wife to invest. So she pays the interest rates, the interest on her share of the mortgage, and that money that she's got there, she invests in any interest or capital gains on that investment is attributed to her. So this is a way of dividing up your finances within the household to try to grow a investment account and investments in a lower income spouse's name. This is usually the part where the question comes up about what happens if you get divorced. And the answer is, if you get divorced, it doesn't matter, because all of the investments within and all of the assets within your household get split up. It's not like your RRSP is different from her RRSP or your partner's RRSP, whatever your relationship is. All of those assets from the relationship are put together into the pot and then divided up. So it's having attribution of different types of investments actually doesn't become relevant at that point. So just to summarize all of that, income splitting can be beneficial if there's a lower income spouse, if there's a drastic difference between the incomes. In the short term, the way that you could income split is paying your spouse a market rate salary, track their hours. If they have more than 20 hours per week for an extended period of time, then perhaps you could a dividend split. I'd want to make sure that I definitely had a good paper trail and met the criteria before considering that. Longer term, you can try to build up the investment income of the lower income spouse. So make sure you fund both the TFSAs. You might consider using a spousal RRSP. If you have excess money left over in the household, try to preserve the lower income spouse's money to invest. And you could carefully use loans if suitable. But again, that I think is very specific cases, and currently it's not all that attractive. So we've covered lots of territory today. There's lots of other resources available with this. So we did get into a bit of how corporate salary and dividends work. So that's always complicated. And Stephanie and I made a video on that previously. I've got a lot of different articles on the Looney Doctor about income splitting, where I've talked about all of these different strategies in much more detail with flowcharts and diagrams and that type of thing.
Great. Thank you, Mark, for a very comprehensive lecture. And if there's any questions, feel free to leave in the comments. So I'll see you in November, Mark, to talk about the physician pension plans. Thanks, everyone.
Looking forward to it. Thanks.